Hello everyone, Jim DesRocher from TrueView Financial in Middleton, Massachusetts. Hope everyone's doing well. So I get the question a lot. We understand it's good to have a financial advisor to help us figure out what our opportunities are, where our gaps, and are we on track for our goals. But aren't all financial advisors pretty much the same? Aren't all investment strategies created equal and pretty much the same? So I got started in 2007 and 2008, and at that time, the world I knew was pretty much we were all the same. And what happened, remember in 2008 was the Great Recession, where the stock markets went down, and I saw in my first couple years in the business people losing everything. And most financial advisors, investment strategies based off of Wall Street strategies. Usually what that means is trying to look through some research and trying to predict the future, predict what stock's going to go up next. And in 2008, when I saw my clients and everyone's clients losing everything and lives being impacted, that they'd never be the same again, I thought there had to be a better way. Wall Street had, and financial advisors had, I thought, little to no accountability. Where the market went down, people lost significant amounts of their wealth that took 30 years to accumulate, and there was no answer, there was no solution. It was, this is just part of investing, and sometimes you lose. That, to me, I couldn't sleep at night. And getting started in an industry, which I love and knew I always wanted to be a part of, wasn't good enough. I knew there just had to be a better way. I needed to be asleep at night, and I needed my clients to be asleep at night. So I did as much research as I possibly could. I talked to as many advisors as I possibly could, coaching programs, and I had a great opportunity to learn from some of the best mentors in the industry, and also go study from the University of Chicago Booth School of Business and a lot of the Nobel Prize winning economists. So what was amazing about University of Chicago is they have more Nobel Prize winners in economics than any other university in America, and they have almost 100 Nobel Prize winners in total from their university. So I thought that was a great place to start. And most of financial advisors' research and strategies come from Wall Street. And I thought there had to be something based more in academics, right? And so what better place to start than Nobel Prize winners? So what I found in 2013, you can see on our Financial Freedom timeline here, Eugene Fama, who is considered the father of modern finance, won a Nobel Prize for his theory called the three-factor model. And so are all financial advisors created equal? Is at the time I thought yes, but now being in the industry for almost 16 years, is investment strategies and financial advisors are not created equal. They're not all the same. There's a lot of rigorous research, time traveling, money spent to learn as much as I possibly can that I found not everyone is committed to doing. So the research I found was not just this, but also in 1954, Harry Markowitz came up with the modern portfolio theory. He later won a Nobel Prize. There was a psychologist from there that also won a Nobel Prize in 2000 for investor behavior. So what I found is on average, the stock market returns on average around 8% over the course of the long run. But the average investor, you, me, only earns around 3 to 4% per year. So half of what we should be earning. So why is that? And one of the things they found is that all the uncertainty in the stock market and hearing the horrible stories of people losing everything makes people very nervous. When they're very nervous, it's very difficult to make good decisions around their investments. They're not sure what they're doing, and more importantly, they don't know why they're doing what they're doing. And all of it was based off of some advisor or Wall Street trying to predict the future, which of course is going to make you uneasy, because at the end of the day, you know no one can predict the future, so your investment strategy is already set up for failure. Now, if it's based in academics, what we can learn from some of these great Nobel Prize winning laureates, one is how do we reduce your risk in your investments? How do we position you to lower that chance of actually losing everything and dramatically lower the chance of losing money over the long run? And increase your return potential. How do you make more, right? Like the market's returning 8, average investors like you are only returning 3 to 4%. Something's wrong with that picture. We gotta be able to do better than that. So the three-factor model is saying there's different places you can invest your money. One place you can invest is T-bills, or you could consider bonds. The other place is stocks. So they went back and looked at 90 years of academic data around how the market works. And over the long run, they found stocks outperform bonds or earn more than bonds. So if you want to earn more, you'd rather be more stocks than bonds. That one's probably not surprising. What we also learned, the next one, is you can invest in small companies or in large companies. And you'd be surprised, most of the people that I see who first come to see me for the first time, when we do what we call an MRI or an X-ray of your investment portfolio to see what you're doing, why you're doing it, and where you can do better, is what I found more people are invested significantly in large companies than small companies. But what the data shows is that small companies, over the long run, significantly outperform large companies. So we're missing a huge amount of rates of return there. And then the last factor was you can invest in value companies or growth companies. And again, most people I see are invested in growth companies. They're very popular, so that's where most people are doing what everyone else is doing. But what the research shows is that value companies outperform growth companies 90% of the time over the long run. So if we can follow this data that's out there, you can do a lot better with your investments. Hopefully that means more certainty around what you're doing, more peace of mind around what you're doing, knowing why you're doing what you're doing so you can feel better and you can make better decisions around your investments. And all that should lead up to better chance of reaching your financial goals with more peace of mind. So if you want to try to do better than you're currently doing, you're not sure if you're doing the right things, I'm more than happy to set a time to meet with you. I would love to share some of this information with you so you can create more certainty around reaching your financial goals. We offer complimentary consultations. You can schedule right on our website, make it very easy, www.mytrueviews.com, and please set up a complimentary consultation. Let's make sure your future has as much certainty as you possibly can. Thank you.